Welcome to our webcast, the CFO Playbook on Reporting, how to ensure an efficient and accurate consolidation and close. Brought to you by Argyle, with support from the sponsor of our webcast, Workday. I'm Joe Fleischer. I'll be your moderator. Now, before we get started, I'd like to cover a few features of the console that you're viewing. I would note that on the left side of the console, you will be able to view slides and polling questions. In a moment, I'll go over how you would respond to polls. I'd also note that during the course of this webcast, you'll be able to download a PDF document that comprises slides from our webcast by clicking on the link to download slides located in the resource list icon area of your console. Now, although we will plan to dedicate the latter portion of our webcast to addressing your questions, we do invite you to type your questions and comments at any time during our webcast in the Q&A area of your console. Now, those who attend this live webcast will have the opportunity to earn a certificate representing 1 continuing professional education or CPE credit. To be eligible, we ask that you respond to all 3 polling questions we will intersperse throughout our webcast. When we display a polling question, we ask that you select the radio button that corresponds to your answer and then click on the submit button so we can record your response. After we have posed our third of 3 polling questions, if you have answered all 3 polling questions and therefore are eligible to receive credit, you will be able to click on an icon within your console to download a certificate that will be located in the certification section of your console. And I would note that if you are not able to retrieve your certificate and you are eligible during the course of this live webcast, if you have answered all 3 polling questions, you will also be able to retrieve your certificate when this webcast is available on demand later this week. I'd like to tell you about our very distinguished guest. Joining us today is Bill Marchioni, Senior Director with the Hackett Group, and he provides CFOs, controllers, and other finance leaders with insights gained during more than 25 years of work in consulting and in various industry roles. He has particular expertise in financial and management reporting, as well as revenue and cost management, working capital management, process reengineering, and strategic planning, forecasting, and analysis. I would point out that before he joined the Hackett Group, Mr. Marchioni, who, like many of you, is a CPA, served as a CFO of a privately held diversified consumer products company. He has also served as Vice President of Finance for Atlanta Gas Light Company, a wholly owned subsidiary of AGL Resources, a billion-dollar publicly traded diversified energy company. So, at this stage, what I'd like to do is launch into our very first question. And Bill, I wanted to get your perspective. For finance teams within companies that maintain multiple charts of accounts, which aspects of consolidation are typically the most challenging and time-consuming in your observation?
Yeah, thank you, Joe. It's a pleasure to be here. You know, when we think about the aspects that are the most challenging and time-consuming, they fall into a couple of different buckets, 2 or 3. Kind of accuracy issues, the ability to do analysis, challenges around comparability. And when you think about charts of accounts, they're often very much associated with and linked to the underlying systems, right? And so organizations that have multiple charts often have multiple underlying systems and vice versa, right? They're not always automated. They don't always speak the same language. They don't always consolidate very nicely. And so many times there's going to be manual activities associated with bringing that data from those various charts of accounts into a particular tool. I will say that multiple charts of accounts, while not an ideal situation, is often a very common situation, and more so than most folks would like. You know, we've seen a lot of M&A activity recently, so a lot of buying and selling and reconfiguring of companies going out there. There's a lot of companies that are in the middle of a transformation. They're transforming their reporting infrastructure and their underlying financial and accounting systems. And so it is not uncommon to see multiple charts. Some of those challenges then become as you have multiple charts, and particularly if there's not good governance structure around those individual charts of accounts, is that each one of those charts themselves can begin to expand and you become more of a thick ledger. And then the question becomes, how comparable are these numbers in reality? And when we try and roll them up and map them, how comparable are we? And what do our policies and our procedures say, and are people adhering to that? And so that leads to double checking. And it leads to sometimes kind of a lack of confidence in terms of, again, the comparability and the accuracy of everything that's being pulled together. And then ultimately when you're trying to do the analysis associated with that, right? So I've got to issue financial reports internally and then quarterly and annually externally, the analysis that goes with that. And to the extent that you've got multiple charts, again, an indication of multiple underlying systems, how easily can you go through that when you're trying to do your analytical review and drill down into the account level detail that you need to make sure that things are booked accurately and consolidated. All of those become very challenging for most organizations.
Thank you, Bill, and I appreciate your pointing out. Oh, I appreciate your pointing out. Thank you. And I just wanted to follow up that, whether we're talking about rolling things up, a consolidation, or it's opposite, even if it's a matter of having to drill down, I think you've acknowledged that both can be challenging. And in particular, I just wanted to follow up and ask, to what extent have you found, given the level of M&A activity or other circumstances, there may be situations where there are multiple locations, for example. To what extent have you found that companies are trying to, when they do maintain multiple charts of accounts, or at least trying to make sure that there's some kind of comparability among these charts, or are you finding that given the nature of M&A activity in general, that you can't guarantee that kind of comparability? And in other words, are you finding that comparability continues to be a challenge for organizations that are absorbing others and therefore different charts of accounts that may not be commensurate with one another, for example?
Yeah, so using the M&A activity example, a lot of it depends on the size of the M&A activity and the frequency and the number of transactions that are being done. And the playbook, if you will, that organizations have. And what we have found is that organizations that grow pretty regularly through acquisition are more inclined to have a well thought out and well disciplined playbook, which basically says when we acquire company X, Y, and Z, here is our plan and our time frame for when they're going to be on our ERP system and when they're going to be on our chart of accounts. For those who may not be as strategic and thoughtful around their M&A activity, maybe they don't do it as often, or maybe they do one or two big ones every couple of years, they may not be as much of a well-oiled machine. Obviously, for financials to be signed off, and publicly made available quarterly and annually, there has to be that level of materiality and comparability, and people will get there. The question is what level of effort and how many late nights does it take to get there? But beyond the external reporting, then the question when you get into more of the lower level detail for the management decisions that are being made, and that level, I'll use the term minutia, and I don't mean that negatively, but the detailed information, then that becomes a bigger challenge for comparability, right? And so some people have a well thought out process and a well disciplined process and time frames around when they'll get to a common chart, and some don't. So it really will depend on that level of maturity.
That's a great point, especially although this particular discussion is not necessarily limited to mergers and acquisitions, that the process of acquiring or incorporating another company certainly needs to include making sure that at least there's ideally a single chart of account, or if that's not necessarily the case, making sure that it's possible to have comparability both at the consolidation level and ideally at the level of detail that organizations need to report internally and externally. What we want to do now is pose the first of our three polling questions. And our first polling question asks attendees to indicate the extent to which you agree with the following statement. My finance team maintains consistent time frames for completing consolidations. What you're welcome to do is select the radio button that corresponds to your answer and then click on the submit button so we can record your response. From top to bottom, the choices are strongly agree, disagree, strongly disagree, I don't know, or if the question is not applicable, that's fine. You can select the radio button next to not applicable. I do ask that after you select the radio button that corresponds to your answer, that you click on the submit button so we can record your response and therefore can record the extent to which you agree or disagree with the statement. My finance team maintains consistent time frames for completing consolidations. And again, the choices strongly agree, agree, disagree, strongly disagree, I don't know, or not applicable from top to bottom. We'll give you just a few more seconds to respond. We'll give you a few more seconds to select your choice and then click on the submit button. And then what we will do is we will reveal how you have responded in aggregate. And what we can see so far, what is readily apparent in looking at your responses, is that for those of you, and it's for most of you, an overwhelming majority, this question is applicable. I will say this is very encouraging, actually, that a significant percentage of you do maintain consistent time frames. I will acknowledge, though, that about 15% or a little more than that do not. So, we invite you to listen. Perhaps we can help you develop more consistent time frames. And also, we always want to help move the needle in that although an overwhelming majority, at the very least, agree, we do want to move that percentage and strongly agree even higher than it is, which is pretty good. 28%, we want to help move that higher. So with that in mind, what we want to do now is ask Bill, I want to get your thoughts. What are the clearest indications the company needs to change its consolidation processes? We've talked about challenges, but how do we know that a company needs to change its consolidation processes?
Yeah, and a lot of that's going to boil down to pain points, right? So what does it take to get the consolidation process done, and am I getting a quality, predictable output from that? And the polling question said that most people feel like, hey, we've got some pretty good adherence to what our current expectations are. But like Joe said, if you're trying to move the needle, that might pose some transformation challenges or focus areas. But so we're big on predictability. So how predictable is it that you're going to get your consolidation done, and how much variation might there be? Okay, so one month we get it done on Tuesday, and the next month it was Wednesday, or one time it was Tuesday at 9 a.m., and the next time it was Tuesday at 9 p.m. When you begin to get that variation, those are often early warning indicators that there's something about the process that's not mature, that's not predictable, that's not repeatable, that's not standardized. So any type of variation, even within a day, can be an indicator that there's something about that process. How much time and effort does it take? And the workload associated with getting it done. What are the peaks and valleys, that are occurring and that are required? How easy or difficult is it to monitor the status and what the results are? So if somebody says, when are the numbers going to be ready, and you're not quite sure, you don't have that at your fingertips, you don't have confidence in the process and the insights into the underlying steps as being able to say, yes, we will have this by 2 p.m. today. You start to hedge your bets on when you'll be able to provide it. And then I think maybe more so is how consistent are the numbers and how much might they change, right? So you do a flash report that says, here's where our revenue is going to be, and then it changes 2, 3, 4, 5 times, and maybe sometimes, if not material from an external reporting perspective, material enough from the internal decision makers to say, whoa, I'm not getting the confidence here in those numbers. So those are all going to be indicators that the process is not where it needs to be. And the amount of rework, and I use the term internal restatement, but again, those numbers that might change multiple times throughout the days as the day goes by. The whole idea of rework, again, that's a red flag that there's something about the process that is not as predictable and standardized as it needs to be. But I think it's also important, as you think about the workload and what it takes to get things done within the time frame, is, are you developing your talent and using your people well, and what's the impact on your talent brand? And that's a big thing that we see a lot of world-class companies focused on, and it's the whole idea of being an employer of choice. And word gets out, and it gets out on the street. And when I say the street, I don't necessarily mean Wall Street. I mean the colleges, the universities, the local employment pool that, go to this company and there's going to be a lot of manual work done. There's going to be a lot of late nights. That word will get around. and that'll probably have negative ramifications in terms of the talent acquisition and talent retention. On the flip side, if that consolidation process is happening very well and without a lot of onerous late nights, that's a good indication, and that's certainly going to help from a talent perspective. But I think all of those pain points, and I would say what we see from the top performers in the example I used, some variation within a day. Some people may say, that's not significant, but the top performers do view that as significant. Hey, it took us 12 hours longer to do it this month, and why is that? And there's something about our process. So that hypervigilance around, what might be encroaching on their optimal structure. So.
Well, thank you very much, Bill. And I just want to acknowledge, I know the Hackett Group does a lot of research, and when you talk about top performers, this is based on research that the Hackett Group has done. And specifically to your point, a day is a significant time period. So in other words, top performers do not take it for granted that a day is a unit of time that they can treat in a fashion that they don't necessarily need to be concerned about. In other words, any effort to reduce the time frame that an organization devotes to the close and consolidation in particular is important to consider, especially if you consider the day to be a significant unit of time in that regard. Now, with that said, Bill, in your observation, what are best practices that finance teams can use not only to isolate bottlenecks, but even potentially eliminate them throughout the consolidation process?
Yeah, so, complexity and complexity reduction. And it's important to draw a distinction between controllable complexity and non-controllable complexity. And we like to say that non-controllable complexity are those decisions that are made elsewhere in the organization, right? What will our geographic footprint be? What are the products and services that we offer? What geographies will we be going into? But beyond that, we as finance professionals, we own how we're going to respond to that, right? And the complexity and the processes that we put in place and the systems and the people and the service delivery model. And so kind of that core continuous improvement mindset, and when you look at a process and diagnose it, there's processing time, right? How much time are we actually working on something? But then there's the downtime. We're waiting on information. For whatever reason, maybe we're waiting on a calculation to be done. Who knows? So that whole critical assessment of the process and identifying those different types of activities that are being done and the downtimes is important. So a little more specifically, it really is kind of data mining the consolidation steps. And we know for a lot of organizations, they have a closing calendar. They know what their consolidation process is, or so they think. And a lot of that may be housed in Excel, or it's been a very static set of steps that they've had in their process. What we've seen the top performers do, and there's a lot of tools out there that will help with this, is getting very granular in terms of what activities need to be done in the close and consolidation process. And let's get those steps listed out in a very granular way. And once they've done that, then it gives them a lot more visibility, and they are able to work that out of the system and drive that. I think an example of that, a client of ours went through really a very similar to what I just described, and they went through a process of every time they made a journal entry, understanding who made that journal entry, when did they make that journal entry, but maybe more importantly, what was the information that went into those journal entries, what was that input, and who were we dependent on within our organization to get that? And sometimes that was an easy fix and some low-hanging fruit. There may have been some communication that needed to be improved upon, or there may have been some turnover out in the field and they just needed to train. Some of the things they had to work through were pieces of data and information they needed to get from third parties that contractually the third party didn't have to provide until day 5, and now they renegotiate the contract to get it on day 2. So I think really taking that critical mindset of mapping out what are those steps and to a real level of granularity, looking for those dependencies and asking the question why. And I think a healthy understanding of materiality and risk for your organization within the context of what the auditors are willing to accept, is critically important too.
Thank you, Bill. And I really appreciate your highlighting the materiality in particular. And because given that there can be so many components when you're talking about a consolidation in particular, now there are new types of tools and resources available, and I just wanted to get an overview, and we're going to cover different categories in general. I want to get your observations about types of resources, tools that finance teams can use, especially if they are working with multiple charts of accounts to close the books not only more quickly, more efficiently, but also more accurately.
Yeah, and so the big trends we're seeing fall into a couple of different buckets. Well, one being cloud technologies, and that is really the trend. The vendors themselves strategically are, moving their models to the cloud with the expectation that in the long term, that's how they're going to offer their products and their services. But the good thing is if you're an organization that's looking to make investments, the ease of implementation from a cloud is very different and much easier than an on-premise type of implementation, and certainly any updates to the tools and technology. So if you are driving a transformation, that the cloud's a real opportunity. RPA, robotics process automation, I think it's on everyone's watch list, everyone's tip of tongue, everyone's interested in, what's going on with RPA. And it is that next wave of software that is going to be able to do a lot of things that we're doing manually. So if you are in a situation where you have multiple charts of accounts and you've got to do some type of mapping or other types of analysis, we're beginning to see RPA being used in A2R in conjunction with ERPs and others to help with that consolidation, that close process, and the related analysis that goes on with that. One thing we have seen with RPA, and it's one of I think the last line I noted here, sometimes that's a long-term solution for folks, but we've talked to others who are saying that in their account to report, they've got some other transformation going on. They are going through an ERP consolidation process. They are expecting their chart of accounts to be consolidated along with that, but that's going to be 3 years down the road. In the interim, we're going to do an RPA fix, if you will, use it almost as a patch, and they're going in assumptions that's going to be a temporary solution. So sometimes, and the price points are such that can work certainly for the company I'm referring to. So sometimes it is the permanent solution, but sometimes it's the technology along the way on the journey that you're on. If we go to the next slide, and I alluded to this before when I was talking about the number of steps and really understanding what's in your process. There's a lot of smart close and real-time close tools that are out there. And we've seen that being very helpful in organizations, again, in what I had described before. It's easier now to capture 600 steps in a consolidation and close process than it was when you had to maintain that in Excel, because these tools are robust enough to capture all of that. So what we are seeing is the folks that used to have 100 steps in Excel are now really saying, no, there's 600 things that are going on in our close process, and I'm going to embed that in a tool, and now I have a better way and more of a real-time way of understanding where we are with those 600 steps. And when I do get that phone call saying, when will the numbers be ready and how close are we, I'm able to give a better, accurate answer. And not only that, I know what's holding up the process more than just kind of the judgmental gut feel stuff. And it streamlines the amount of status communication that needs to happen, and it's more problem-solving communication that needs to happen. And there's bolt-on tools and technologies out there from a close, consolidation, and reporting perspective that many top-performing companies are adding to their portfolio of solutions.
Thank you. And just without mentioning specific vendors, when you talk about the bolt-on, in other words, are these attaching themselves to particular types of tools? In other words, what is the bolting on that's occurring? Just for the sake of understanding how that relates to the close process and consolidation process.
Yeah, so good question, Joe. There were probably two things that I was thinking of when I was referring to that, and one's at the close process and one's at the consolidation process. We talked about the scenario being when there's multiple charts of accounts and therefore multiple underlying systems, et cetera, et cetera. So there are those consolidation tools that will allow at a certain level for that consolidation and that mapping and that ease of reporting out at that level. Some of those are embedded into ERP systems, but oftentimes people will go out because of the robustness of some of these specialized, bolt-on technologies, and they'll layer that on top of their ERP structure. And then for more of the close process, there are just certain steps, within the close process where people may be using that technology. Again, the smart close and real-time close tools that give you the status, that can be used at two layers, right? That can be used overall at an enterprise level that tells me where am I with my topside consolidation and that output part. But there's also all of that other stuff that happens in the days before from all the global business services and all the submitting locations and having those tools available to them. And other aspects like reconciliations and things like that, we often see bolt-on technology being used.
Exactly. I appreciate your elaboration there. And now that we've talked about challenges and tools, types of tools, we do want to talk about best practices. And in particular, I want to pose our next polling question. This is the second of three. We want to find out the extent to which you agree or disagree with the following statement. My finance team maintains uniform reporting practices among multiple lines of business, locations, and/or markets. So if your organization maintains multiple lines of business, has multiple locations, let's say, or operates in a variety of different markets, any combination, we'd love to get your perspective. You're welcome to select the radio button that corresponds to your answer and click on the submit button so we can record your response. From top to bottom, the choices are strongly agree, disagree, strongly disagree, I don't know, or not applicable. After you select the radio button that corresponds to your answer, we do ask that you click on the submit button so we can record your response and find out the extent to which you agree with the statement. My finance team maintains uniform reporting practices among multiple lines of business, locations, and/or markets. And what we will do is give you just a few more seconds, not only to select your choice, select the radio button that corresponds to your answer, and then click on the submit button so we can record your response. And then what we will do is reveal an aggregate how you have responded. I will acknowledge that it does appear so far that there is a fair amount of agreement, which is great. And in fact, we're going to reveal how you have responded. So the good news is, overall, there's great agreement, significant agreement. And when we look at the numbers here, more than 3/4 of respondents overall, at the very least, agreeing. As always, there is going to be some disagreement, and in particular, we do acknowledge that for those of you for whom this question is applicable, I do want to acknowledge that there is a percentage, in this case, roughly, overall, close to 14%. So let's say about a seventh of respondents at the very least disagree. So with that in mind, what we want to do now is talk about ways that organizations can maintain the uniformity of financial reporting. And so, Bill, I want to get your point of view here. What can finance leaders do not only to maintain the uniformity of financial reporting practices within companies that have multiple lines of business, but also, is uniformity even feasible, or to what extent is it feasible for companies that operate in a variety of locations or markets? What have you observed?
Yeah, so it was good news to hear that the bulk, and I guess at a high level in 80/20, that folks were comfortable with their reporting that they've done. But, the typical things we see are really aggressive leverage of templates and submissions. So I guess maybe templates aside, a solid understanding of what information is needed for, at the top side, consolidated enterprise external reporting. So what are we going to need? How is that going to roll up? Are we comfortable, and have we vetted all of that? And are our systems speaking to each other, and how much manual activity is going on there, right? So Once you've gotten that, now you're beginning to talk about perhaps other data that you're going to need, right? And so the aggressive use of templates, where I'm going to need some subledger detail for particular information that I need for a footnote disclosure, or I'm going to need some statistical information that I may or may not be getting out of my tool set. And most importantly, I'm going to need some explanations and some understanding and some narratives around that. So really that aggressive use of that, not only for any of the things that are developed internally around templates and narratives, but also that this is another area where there are best-in-breed technologies that allow for the gathering of narratives and disclosure and explanation information that can be done online as opposed to kind of old-fashioned email stuff. The ability to enforce expectations across cultures, time zones, and businesses. In fact, I was at a seminar yesterday, and someone talked about their close and consolidation process and said, yeah, we've got a cultural problem. Most people think that our deadlines are suggestions. And so, we put deadlines out there, and we don't always enforce adherence to that. That clearly is a cultural challenge for them, or a cultural issue. And I just think as companies begin to grow, go into different geographies, get different businesses that maybe they didn't have in the past, that can become a potentially festering type of red flag that may be out there. Joe, I think the second part of your question around, to what extent is uniformity feasible? Well, certainly there's complexity, and you've got different markets, different locations. We deal with multinationals all over the world. Some of the biggest companies, in the world. I'm sure some of those are on the line here, and it's an investment of time and talent and systems to get that uniformity. But the answer is yes, you can get the uniformity that you need to make the decisions and do the disclosures that you need. I don't think organizations should think that they may be too complex to achieve what they need to achieve. And not to get sidetracked too much, but we work with a lot of companies, and we identify top performing companies out there using a very analytical model. And it's interesting when we work with smaller companies, and that's a relative term, $1 or $2 billion, they say, we're too small, we can't get the world class because we can't get economies of scale. On the flip side, when we talk to $100 billion companies, they're like, there's no way we can get the world class because we have too much inherent complexity and we'll never get around it. And the reality is we have world-class companies on both ends of the spectrum. So from a philosophical expectation perspective, absolutely you can get to the comparability that you need. It's not going to happen overnight. It's not going to happen with a hodgepodge of quasi-manual steps. But with some of what we've discussed already, putting that together, you can absolutely get what you need and what the business is demanding of you. And those expectations, and I'm thinking at this point about kind of the internal customers, those expectations on finance and accounting are going to go through the roof as they deal with challenges in the business environment. They're going to be looking for accounting to provide a lot more. So I think as you think about building a set of tools, a reporting infrastructure, a process around producing information, it's important to think about agility in that process. So.
Thank you, Bill. Before we continue, a thought occurred to me that when one considers uniformity, one is also thinking about the ability of an organization, for example, and it's not just technology, it's processes and culture to some extent as well, where we were talking about the notion that a day for many organizations, particularly top performers that Hackett Group has looked at, a day is a material period of time, but in other organizations or in other parts of organizations, a day, well, it's just another day. Not to harp on this necessarily, but have you found that whether they're multinational or organizations that have multiple locations, have you found that organizations that you've worked with are trying to maintain a uniform standard, even in terms of what they consider to be a material period of time, whether it's consolidation or the overall close? In other words, if we factor in the tools that organizations potentially have or actually have access to, as well as processes that can help accelerate the close and streamline consolidation. What are you seeing in terms of establishing uniformity just at the level of time frame in which an organization can complete a consolidation or even complete a close?
Joe, is your question uniformity across different companies or within a company?
Within a company. In other words, in an organization, so to clarify, in other words, where within the company, where there are multiple locations, there's been an acquisition, achieving uniformity in the notion of what's a material period of time to complete a close or at least complete a consolidation. What are you finding in organizations that you've worked with that are striving to maintain or establish uniformity within the organizations, particularly, let's say, following an acquisition or where it maintains multiple locations, for example?
Yeah. So let's stay with that M&A example. For the top performing companies, going out and acquiring a company or spinning one off is not an excuse and not a valid reason for letting your cycle times and your costs start to deteriorate. The expectations are that organizations will continue to be at a high level. Just in terms of a couple of metrics, the typical company in our database closes and consolidates in 5 days. The top performers are around 3 days, and we do have some that close in the 1 to 2 day range. So there are some pretty interesting and exceptional performance standards out there. So I would just reiterate that just because the strategy of the firm is to go out and start to buy, you can't let your cycle time go from 5 days to 10 days. It's just not acceptable, right? Related to that, and this is a story of a top performer, and this is a company that essentially gets consolidated results on day one, and they close or they analyze for a couple of days and they sign off on day 3. That's their time frame. When they shared their story with us, they basically said that when they think about their budgets and their reinvestment in that process, right, that's a really good process. And it's very, very predictable. No variation, very few, if any, adjustments after day 1. It's really just analysis and disclosure. They're very, very good. When they told the story with us and shared it with us, they say when they think about their budgets on an annual basis and they think about the capital budget allocated to the controller and the finance organization, 80% of that budget is reinvested back in that process. That's a world-class process today. And they continue to reinvest the large majority of their annual capital budget and related projects in that same process. And the reason being, they know their world is changing. They know that they're going into countries they haven't been in the past, and that's going to put pressure on their process. They know that they're going into geographies with language challenges and infrastructure challenges. They're getting into different products and services that are going to impact their chart of accounts. It's going to impact all of those steps. And so it is a recognition that you never check that box and you're finished. So I think that, Joe, I think that's a good example. This is a top performing company. They're head and shoulders above just about everybody else in the close and consolidation process. And it's still strategically, from a finance perspective, one of the big areas they continue to invest in.
Thank you. I appreciate the example. I think we might even return to it very briefly towards the end of our discussion, and I appreciate your mentioning that. And what that also points to is the shorter the time frame, the higher the performer, the more significant a day or time in general becomes. So that I really appreciate your highlighting that point, especially with the top performers that you've observed and worked with. And this indeed leads to my next question, which is, what obstacles do finance teams and finance leaders often encounter when attempting to improve visibility into specific areas, especially if it's an organization that maintains subsidiaries or business units? And how can finance teams overcome obstacles to maintaining visibility into specific areas of their companies? What have you observed? Let's start with the obstacles first.
Yeah, and Joe, when you talk about visibility, I guess there's two things I think about. One is visibility into the results of those business units, and the other is visibility into the process that's being done. And I think for some organizations and the people there's a fair amount of fear, right? The corporate watchdog. Okay, here's somebody looking over my shoulder, and now they're saying, oh, my process stinks, or why are you doing this? Or you're supposed to get this done on day 3 and it's not getting done until day 4. Why is that? So there is a level of scrutiny, certainly as people focus and get more sophisticated tools and technology in support of some of this, that is going to put some pressure, on parts of the business. And then the other, as you start to tighten up the process and the close and the consolidation process, is people want to see the results. They want to see them faster. And then the questions are going to happen faster, right? If I have an online tool where I can go on and I can see there's 600 steps and I can see that somebody, is behind on step 2 or 3, I'm going to start to ping them and say, what's going on? Similarly, as results start to come out and you submitted a flash of $1 million and now the actual is 800,000, what's going on? So there's going to be, I think, a change in the dynamic of organizations, and there's cultural complexities that play into that. There are parts of the world that are more detailed focused. And their level of materiality may be very different, and some of that is cultural, and some of that is statutory, right? So I know a lot of organizations struggle with that challenge, and working with different regions, in the around the world. In that. So, just kind of that resistance, that those different cultures, that's going to be a challenge. If your underlying technology platform is very complex, it's going to make it more difficult to get things within the time frame that people want. On the flip side, if you have a less complex reporting infrastructure, and again, if we think about charts of accounts, you've gotten on a common charts or something approaching that, everything becomes a little bit easier. So those are some of the obstacles. I think when you think about overcoming some of those obstacles, and Joe, if we go to the next slide, formal change management, formal transformation, program management offices are differentiators that we see. Top-performing organizations don't do their transformation ad hoc. They have the structures in place. They invest in those structures, the change management office, et cetera, et cetera. And they leverage a global process owner. Now, a global process owner doesn't mean that this person's executing all the account to report stuff on a day-to-day basis. They're not, per se, operationally dealing with what's going on in A to R, but they're making a lot of decisions, right? They are fighting for the budgets. They are saying, here's what we're going to do with our tools. Right now we have 5 different tools in 5 different regions around the world. They're not speaking to each other. We've got some challenges here, and we're going to consolidate, and this is the direction we're going, and I'm going to make those decisions, right? So that is a key differentiator that we see organizations using to overcome those obstacles. Obviously, whoever's going to be in that position has to have the institutional heft to get those things done. They have to understand a lot of the complexities around legal entity structures and reporting, et cetera, et cetera. But that is an emerging practice and a differentiator that we see at this point.
Thank you, Bill. Before we continue, I know that this is really high priority that you've identified. What and obviously there are soft skills that a global process owner ought to have, but just in terms of an understanding of account to report, are you finding that the organizations that you've worked with are seeking specific skills or experience or capabilities, technical experience, in looking to identify somebody who takes on the role of global process owner for account to report?
Yeah, and you referred to my comments about the softer skills, but on the more technical side, really 2 things. They have to have the technical accounting knowledge, and I define that very broadly. That could be U.S. GAAP, that could be IFRS, it could be financial reporting, it could be tax, right? So they really have to understand the implications of things, because this person is also going to be making decisions on what's acceptable to be in our chart of accounts. And they are going to get tax asking and requesting for certain things. So this is someone who has to be technically astute across all of those dimensions that I mentioned. They have to have the intellectual or the institutional knowledge of how things are structured, and that chart and that legal entity structure, but they also have to understand the underlying tools. So this is somebody who has to know more than just how to spell ERP, right? They have to have used it and understood it and manage the teams that do that. So yeah, I'm glad you brought that up, Joe. There definitely is a technical component. It's not an easy job description. The qualifications are, you have to have a fair amount of experience and great skills to be effective in that position. But that is a differentiator, and that's where we see people staffing up and focusing.
Thank you, Bill. And by the way, as far as soft skill, what are often referred to as soft skills, of course, the ability to communicate among multiple areas, not just lines of business, but different people with a variety of roles. To your point, people who have the technical understanding, not only in terms of accounting, but also technology. So it is a role that we're going to refer to and return to in even considering our subsequent questions. Now, in your experience, Bill, what mistakes do CFOs most often make in their efforts to try to simplify or streamline financial consolidation and close processes? And given your experience of mistakes that finance leaders and finance teams are at risk of making, how can they avoid or prevent these mistakes?
Yeah, so a few things we see, one of which is in many cases, a reluctance to make the necessary investment. And I say that if you think about the mindset and the culture and the professional experiences of a lot of finance and accounting people, it's about numbers, and if I can do it cheaper, then that's probably a good way to do things. Why do I have to invest now? Here's a potential workaround. And being in the CFO seat, and you're preaching to your colleagues that they need to do more with less, and they may be in revenue-producing capacities, the CFOs are often very reluctant to make certain types of investments, and sometimes to their own detriment. So that's a challenge, but it's one that that some CFOs don't get over and some do. I think another thing is really planning for agility. You might be doing things very well today, but things are going to change rapidly. And will your team and your process and your tools be able to scale and respond quickly? And we have seen even top-performing companies, they did very, very well when their industry was static. The reality for most industries now is they're not static. There's a lot of disruption going on, a lot of volatility, and they just don't have the systems and the people in place to respond. So I think those are a couple of big mistakes that we see folks, that we see CFOs doing. So we would say, maintain some investment level. It may not be optimal in the eyes of everyone in accounting and finance, but you do have to make investments so you don't fall too far behind. And the other thing is, as you think about the service delivery model and the organization of the future, really understanding risk, being able to measure risk and risk tolerance. And we see great variations. We see CFOs who maybe got burned elsewhere in their career, and they're very reluctant to adopt materiality and statistical sampling and those types of things. But that's the trend. That's the way it's going to go. The auditors are beginning to use a lot of statistical sampling more than they have, and it's going to be incumbent upon CFOs to think in a more sophisticated way. And for those who fall short on that, those are the things. And obviously change management. Anytime you make a change, the people involved are going to have concerns. What does it mean for me? Is this a career enhancer for me? Is it not? What's the roadmap here? Help me understand that. And those who don't and aren't able to paint that picture and consistently communicate in an understandable way, that they run into challenges.
Well, thank you, Bill. And since we've talked about the mistakes CFOs can make, there's also the opportunity to prevent these mistakes. And so, what would your recommendations be, particularly following up on our previous question about the role of the counter reports process owner, for example?
Yeah. So we talked about the process owner. Again, it's an important position. It's not an easy one, but it's one that will make a difference. This is somebody who will think broadly, think across the enterprise, think wide across businesses, business lines, geographies, but also think deep, between the finance, accounting, reporting, tax. So involving a A to R process owner and having that person part of the design is obviously going to be key. Account to report service delivery model, I've mentioned that before, but I haven't elaborated on that. But it really is that whole mindset of there's a lot of pieces that have to work in unison here, right? What should my process look like? How automated will it be? Where will the controls be? Which controls will be automated? Who's going to be involved in my process? Are they part of the business unit? Are they part of a global business services? Are they part of corporate? What type of governance am I going to have around my process? So, hey, I'm about to streamline my chart of accounts. I better make sure I have proper governance in there. I'm going to have an end-to-end owner. Where do those lines of responsibility start and end? What type of information and analytic skills am I going to need? And so that periodic assessment of that holistic thought and that holistic roadmap is critically important so things don't get out of balance. And with the amount of change going on in most industries, things can get out of balance very quickly. So we recommend understanding the service delivery model, applying that to your organization, and assessing that on a regular basis. And then, be open to investment decisions that don't meet traditional ROIs. We talked about robotics as a possible solution. Some robotics have great ROIs, and depending on how you use it, some of it may not. It may get people out of the business. It may free people up to go to other parts of the business. But there are certain tools, and I mentioned kind of that close process technology that captures and can report real time where you are in those 600 steps. There may not be a traditional hard ROI on that. And some CFOs will say, well, if it's not there, I'm not going to do it. Others will say, I get it. I can see how this is going to play to my scalability. I know strategically we're going to grow very rapidly here. I need that type of tool. And they'll go ahead and make those decisions. So I think being open to the things that don't meet the traditional standards, sometimes those decisions have to be made.
Thank you, Bill. And I appreciate your noting the need to perhaps implicitly even consider redefining what ROI is in the context of streamlining consolidation and close processes. And I wanted to ask you, what are key takeaways you want attendees to remember from our discussion? What should be top of mind for attendees following our discussion about improving consolidation and close?
Yeah, so a few things. One is I would say continue to invest in the process. Invest our dollars if necessary, but invest the time, invest the focus, invest in the people and the process. To give you some indication on some metrics that we have, in the last, if you were to go and look over about the last 10 years, for the typical company, for the first 7 years of that 10-year period, their cost of account to report went down. And 3 years ago, it went up. And so for the typical organization, their cost for account to report right now is about 10% higher than it was 3 years ago. And that's in large part because in the 7 years preceding, they were taking a lot of shortcuts, right? They were not investing in a sustainable, repeatable, agile, scalable model. They were doing lots of shortcuts, and it worked for a while. And they were trying to work off some past sins and some past things that steps they didn't take. And now all of a sudden, things are changing rapidly. They're not able to change. On the flip side, what we saw for world class for the first 7 years, they were actually kind of staying within a relevant range and kind of flat. And in the last 3 years, they've improved their efficiency and reduced their cost by 16%. They're focusing aggressively on A to R. They had been focusing aggressively on P2P and order to cash, and now it's A to R's turn. And so the data showing a divergence in what we're seeing. So I would say if you're investing in your time, and it doesn't have to be dollars, but your time, your focus, your process, and your desire to improve things, if you're doing that, good, because the world-class companies are doing that. And if you're not, realize that many people are. So that ability to continually invest. I shared earlier that story about that investment of 80% of the controllership budget in a process. It is about continuous investment. It is about continually getting better. The journey never stops. You never check the box forever. And I mentioned that service delivery model, that holistic view of the different component pieces of complexity to continually refine that and review that. And we have many of our clients, and we share with them our model, and they have it on one PowerPoint slide. Their leadership carries that with them, and they review it on a regular basis. It's a quick reminder. Certainly, if you're going into budgeting and planning and design season, it would be important to make sure you are thinking holistically about those various component pieces.
Thank you very much, Bill. I really appreciate your noting the example earlier, and we're just recapping it here. And also your point about investment and reviewing and refining the account report service delivery model and the processes that underlies. And with that in mind, what we want to do is pose our third polling question, and this is the third of our three polling questions, our last polling question. We want to ask attendees, within what time frame, if any, does your organization intend to streamline its consolidation processes? You're welcome to select the radio button that corresponds to your answer, and from top to bottom, the choices are: we've already done so this year, next year, the year after next, we don't intend to do so. If you don't know, you can select the radio button next to I don't know, and if the question is not applicable, that's fine. You can select the radio button next to not applicable. But we do ask that you select the radio button that corresponds to your answer and then click on the submit button so we can record your response to the question. Within what time frame, if any, does your organization intend to streamline its consolidation processes? And what we will do is give you just a few more seconds to respond. We'll then reveal how you have responded, and then we will plan to wrap up our discussion. And so far, what we can see in looking through responses, and this is actually very encouraging, is that a plurality have indicated next year, and considering that that's fairly soon, that's great. A number of you have done so this year. So clear majority, if you have either done so, kudos to those of you who have, about a fifth. Majority have either done so or are planning to do so this year or next year. For those of you who don't know, we're glad you can join us for our discussion. Perhaps we've been able to influence you in terms of streamlining your consolidation processes. And I also want to just quickly address a quick question from an attendee, and this is just following up. To what extent do you see that Bill, do you see that A to R is becoming a priority in the organizations that you're working with? Just a quick answer, but just wanted to see, is it becoming, or a simpler way to put it, is it becoming a higher priority recently among the organizations that you've worked with, A to R in particular?
It is, and I'll refer to the comment I made shortly about some of that trend data, right? And I'll talk about top-performing companies, and these are the thought leaders, and these are the people who are getting things done. There was a big focus on procure-to-pay and order-to-cash for many years. A lot of transactions going through that, a lot of dollars, et cetera, et cetera. As I mentioned, the data shows the top performers have reduced their cost, and that's a good proxy for efficiency, by 16% over the last 3 years. And that is because they have now focused on that, and they have made that a priority. So absolutely, we are seeing A to R as being a focal point. And I think one of the good things is there's a lot of capabilities that have been developed over the last 10 years that can help organizations leapfrog. But the data tells us, in addition to all the conversations we're having with clients, the data tells us that absolutely A to R is on people's radar screen and on target as an area that they're going after.
Thank you very much, Bill. I want to acknowledge we've received a lot of great questions from attendees. We may not have had the opportunity to address all. We'll follow up on any remaining questions after our webcast. Also, in addition to thanking you, Bill, of course, and attendees, we want to thank the sponsor of our webcast. What we will now do is display some information about the sponsor of our webcast, which is Workday. Also want to note that this webcast will be available on demand later this week within the webcast section of CFO.com. that point, you'll be able to view and listen to a streaming archive of our webcast, as well as download a PDF document that comprises slides from our webcast. Also, if you have answered all 3 polling questions during the course of our live webcast, if you're not able to retrieve your certificate now within your console, you will be able to do so when this webcast is available on demand later this week. Finally, I would note that at the very end of our webcast, we will invite you to complete an online feedback survey, which you will be able to view in a separate browser window if you've turned off your pop-up blocker within your web browser. And as always, we appreciate your feedback. I'm Joe Fleischer, moderator of our webcast, and on behalf of our very distinguished guest, Bill Marchioni, Senior Director with the Hackett Group, we very much appreciate your joining us for our webcast, the CFO Playbook on Reporting, How to Ensure an Efficient and Accurate Consolidation and Close, brought to you by Argyle with support from the sponsor of our webcast, Workday. We thank you for your time, and we hope you enjoy the rest of your day.